All right, we've got 17 people on the line. We're going to kick off momentarily, and I'm sure that many more will be joining us. I want to welcome everybody to Building a Hedge Fund Portfolio, a very special webinar hosted by the World of Allocators and featuring the one and only Philbert Qua. We are very happy. Welcome to Nicole. Welcome to everybody that is online. Feel free to have your cameras on or off, but we will ask you to keep your mics off for the webinar. Couple housekeeping notes. Today's webinar will be recorded. And so is technically on the record, but of course be circumspect. You are welcome at any time to ask questions in the chat. And we'll have a dedicated Q&A time for direct questions. You can open your mic and ask questions directly at the very end. We'll plan to keep it at about 75 minutes. We'll have a little bit of a structured presentation that Philbert has put together at the beginning, and then we'll turn it over to a little bit more of a fireside chat dialogue and then audience Q&A. Just a word about World of Allocators. For those that are joining us for the first time, World of Allocators is a non-commercial, that is not-for-profit GP-LP community dedicated to promoting learning, sharing, and connectivity in the asset management industry in Asia Pacific and beyond. We experiment with different versions of the intro in different webinars, but for now, I'm going to post a copy of our introductory deck into the chat. So if you would like to learn more about World of Allocators, our community of GPs and LPs, our many events in major cities, financial hubs across Asia Pacific, as well as our online webinars and community initiatives, please do take a moment to look at the deck and then reach out to me or one of the WOA team members to learn more about joining our community. We are growing fast and really committed to making this a valuable community for learning, sharing, and connecting in the industry. And so love to hear from you. With that, I want to jump right into our main event, and it's a pleasure to introduce Philbert, who is a managing director and leads research at Atos. And there is responsible for data and the development and management of their analytical systems. Previous to Atos, Philbert was at Perry Capital and at Citigroup. He has a dual degree in economics and computer science from Penn and his MBA from Stanford. And he is a member of the United Nations PRI, that's the Principles for Responsible Investments, Hedge Fund Advisory Committee. So really engaged in governance and leadership in the hedge fund industry globally. With that, it is a really terrific opportunity to welcome him to WOA. Philbert, thank you for joining us, and we'll say hello to the crowd, and then in a moment I'm going to invite you to jump into your presentation.
Thank you, Jonathan, and thanks everyone for having me here today. And above all, thank you for being so generous with your time during your lunch hour. So really appreciate it. Jonathan, can I share my screen?
Yes. Do you have that? There we go. Allow. You're on.
Right. Right. I think it's. Can everyone see the screen?
We're looking good.
All right. Well, again, thank you everyone for having me here today. My name is Philbert Qua, and I am one of the partners on the investment team at Atos, where we manage absolute return hedge fund portfolios for institutional clients and also provide some outsourced CIO offerings. I've been doing this for close to 15 years, and before that, I was in hedge fund land myself as a stock picking analyst in in Asia. And today, I'd like to give you an overview of hedge funds, go over some common strategies, and talk about why these could make sense for institutional portfolios. Then we'll open it up to a discussion regarding the issues we consider in manager selection and portfolio construction, as well as any other questions the audience may have. So with that as our agenda, we can just jump right in. And before we, I guess, go into the nitty-gritty, it might be useful to first define some terms so that everyone is on the same page. And I apologize if some of this sounds like very repetitive and it's very simple to the more experienced investors here, but I do think that it's important just to like level set everyone. When we first define like these terms, what are hedge funds? Hedge funds, the funny thing is that it's actually a misnomer because although some of these funds do hedge their investments, others do not. But in the most inclusive definition, what are hedge funds? They are simply investment vehicles that can invest in various asset classes, stocks, bonds, derivatives, commodities, currencies, for example. And then they are allowed to take long or short positions, meaning that they can take directional views. And also these funds often charge a combination of management and incentive fees. Now, it's important to note that hedge funds are not monolithic. They vary by investment strategy. We'll go through some examples of that later. Risk management, fees, as well as liquidity terms. With all that said, for purposes of this discussion, we will use the term hedge funds to refer to strategies that have moderate exposure to broader markets, meaning that they often engage in some form of hedging to protect against downside risks. So with that, we can talk about why hedge funds and what role could they play in institutional portfolios. Before we do that, let's take a step back and just go over institutional portfolios some more generally. So there are many ways to run institutional portfolios, and each CIO may have a different approach. Indeed, each institution has its own needs and may be in a different stage of development. That said, I can speak to the approach we follow at our firm, where our clients tend to be more established institutions, think endowments, foundations, pensions, family offices that rely on their investment portfolios to achieve their respective missions. So we start off by thinking about the different functions of an institutional portfolio: growth, income generation, inflation protection, and risk mitigation. And then we assign various asset classes to each function. So under our approach, the growth or capital appreciation portion of the portfolio, this is on the upper left quadrant of the page. This portion of the portfolio tends to be represented by long-only equities, whether public or private. This is meant to drive the growth in the portfolio's long-term value. Though we also need to be prudent about how much to allocate to this bucket. If we put everything here and markets hit a rough patch, it could become challenging to tap the portfolio for funds to support the institution's missions. With that in mind, to complement the capital appreciation function, we often have an income-generating portion of the portfolio as well, which is meant to provide a stable income stream for near-term spending requirements without needing to liquidate the growth bucket. Fixed income securities like investment-grade bonds, high-yield bonds, and loans usually go into this category. And then inflation is another topic that has been front and center of headlines in recent years. One of the risks we consider is the possibility of inflation eroding the real value of the institutional portfolio. A way to counteract this risk is by investing in assets like real estate and natural resources, which are viewed as more resilient during periods of high inflation. And also inflation-linked bonds are another option in this toolkit. And then finally, this is where we'll center today's discussion. We have a risk mitigation and diversification bucket, whose purpose is to protect against downside risk and improve the risk-return characteristics of a portfolio. Absolute return hedge funds tend to go into this bucket. Let me just spend a minute on why we think this category is an underrated tool in institutional portfolio management. Again, it starts with the institution's needs. If you're able to sock away your capital and not touch it at all for more than a decade, it's hard to argue against allocating more to the growth bucket. However, if you envision your organization needing access to some of your capital, for example, to fund a school's operations, to support charitable endeavors, to disburse retiree pensions, or to pay for your family's projects, and these needs could conceivably come during a downturn, then you might want to have this extra tool on hand. This bucket also enables added flexibility during such downturns, and it provides a source of dry powder with which to play offense on opportunistic investments. And we'll talk more about this later. And so why hedge funds? Why do institutional portfolios have hedge funds, and what role do these funds play? I think there are three high-level answers to these. Number one is attractive risk-adjusted returns. First, we think that hedge funds, especially the low to moderate beta variety that we're talking about today, provide attractive risk-adjusted returns on a standalone basis, where the expected return is between that of equities and bonds, while the risk is closer to that of bonds. At least that's the expectation. In addition, when combined with the rest of the portfolio, hedge funds could improve the overall risk-return balance of the entire portfolio as measured by the Sharpe ratio. Second, we alluded to this earlier, hedge funds could add diversification to the institutional portfolios. I won't bore you too much with the efficient frontier chart in this page, but the idea is that if you start with a portfolio of stocks and bonds, and this is a reasonable starting point for institutional portfolios, given how many people still reference 60-40, meaning 60% equities and 40% bonds as a starting point. By adding hedge funds, you could squeeze out additional expected return for a given target level of risk, or given a targeted level of expected return, one should be able to lower the expected risk of the portfolio. And then number three is the balance of liquidity and downside resilience. Going back to what we said earlier, hedge funds can be a tool for both defense and offense during downside scenarios. Defense, because hedge fund portfolios, or at least the ones that we manage, tend to hold up better during downturns and are also relatively liquid. So they could be tapped for funding needs when liquid assets like venture capital or private equity might be harder to sell. Additionally, it might not be the most prudent action to sell dislocated assets like long-only public equities during a downturn, think as recently as 2022, because these prices would presumably be down significantly, and then selling them would make permanent what otherwise could be just mark-to-market losses. As for offense, if your organization decides that not only will you hold on to your temporarily dislocated assets, but you would like to go further and take advantage of attractive pricing by buying more of these assets, then you could tap into your hedge fund holdings to raise funds for these purchases. And before we open it up to a more free-flowing discussion, I'll just go over some hedge fund strategies on the next slide here. So as mentioned earlier, there are many hedge fund strategies out there, and this slide contains a non-exhaustive list of examples. We classify hedge funds into two categories, just to simplify the world, liquidity-driven and skill-driven strategies. On the left half of the page are what we call liquidity-driven strategies, which earn a quote-unquote premium by providing short and medium-term liquidity to market participants. So arbitrage and distressed strategies fall into this bucket. The return profile of these strategies tends to be comparable to someone writing insurance. How you collect a slow and steady flow of premiums most of the time. And then when an adverse event happens, in this case, when liquidity seizes up, you pay out in the form of losses. The idea here is that portfolio managers need to be good at underwriting downside risk so that even after paying out during loss-making periods, the strategy as a whole is still profitable net over a cycle. And this is not to imply that because it's liquidity driven, no skill is needed. In fact, the opposite is true. This requires considerable amount of expertise because your upside is often capped. You usually know in advance what the merger price is if a deal succeeds, and similarly, when you have a distressed bond, usually it maxes out at par, and so it becomes very, very important to be able to underwrite those downside scenarios and the probability as well as the magnitude of losses during those scenarios. On the right half of the page are what we call skill-driven strategies. Long-short equity and macro strategies fall into this bucket. The return profile of these strategies tend to be chunkier, meaning that it's not unusual to see funds that might generate several quarters of average returns that have periods of outsized contributions. Indeed, the timing of return generation for these strategies can be a lot more open-ended compared to some of the liquidity-driven strategies that we discussed previously, where one might have better confidence in predicting when deals might close or when companies might emerge from bankruptcy. By mentally classifying strategies into these two buckets, along with taking note the vertical axis of their beta to broader markets, we're also laying the foundation for portfolio construction, and that we'll talk about later. So any questions on this, I guess, very quick intro / level setting exercise and hedge funds before we jump into sourcing, evaluation, portfolio construction, and Q&A?
Thanks very much, Filbert. Certainly, if any of the audience members have questions, please feel free to put them in the chat now. I'd like to ask one question in the meantime about how this is changing, how this is dynamic over time. And does this framework represent something that is evergreen and eternal? Is it something that you are constantly updating, or that responds to market trends in the landscape? And when we think about what's trends that are relevant to today and the future, how is the future going to potentially look different than the past?
That's a great question, and thank you for that. I would say that hedge funds have been around for a long time. Admittedly, that landscape and return profile has also changed over time. So in the early 1990s until the time I started working in the industry, which was in the early to mid 2000s, hedge funds seemed like a magical investment where one could achieve equity-like returns with bond-like risk. And over time, the sources of excess return generations have gotten eroded somewhat with more competition. A lot of this was also accelerated by technology. Now that role may have evolved a bit. What hasn't changed is the focus on downside protection. So hedge funds in the past, maybe they were this silver bullet where you got low risk but equity-like returns, so it could go into the capital appreciation bucket. But now I think at least the way that we construct institutional portfolios, we view hedge funds as providing more of a risk mitigating function. It's not to say that there aren't hedge funds out there that can still provide outsized returns, but if you do want to create a diversified portfolio of hedge funds and you are underwriting longer term returns on a sustainable basis, it is, I think, important to be honest and upfront about expectations with the the clients. And just because one hedge fund has had like a couple of outsized years doesn't mean that it'll keep having those outsized years going forward. And our job in creating like these hedge fund portfolios to continue underwriting these managers. Certainly, it's become a lot more competitive. But the flip side of that is there are also a lot more hedge funds to evaluate out there and more options to pick from when constructing hedge fund portfolios. So to answer your question, it definitely is an evolving landscape, and there's no shortage of new managers to keep us busy.
In addition to the increase in competition, more crowded space and more hedge fund participants in the market, there's also been the rise of passive investment and ETF indexing. How has that impacted the alpha generation potential and the landscape on which even the best hedge funds are playing?
That's another great question. Thanks for that. So I think that passive products are great because oftentimes passive products provide beta, and these tend to be lower cost products, and beta is not meant to be expensive. You should be able to acquire beta cheaply. So to the extent that you have like an equity allocation and just want to passively allocate to large cap indices around the world, like the MSCI All Country World Index or the S&P 500 index in the US, that's great. And this is definitely a much welcome tool in the toolkit. That said, passive can't fulfill all of the requirements of your portfolio, especially if you, as we mentioned earlier, you want to be able to act more tactically during periods of downside stress, right? And so I think that long story short is that there is a role for passive in the portfolio, but that doesn't mean that you can't have active management there either, because active management can still provide additional alpha over passives. You just have to make sure that you are paying for the alpha and not beta. And then number two is that it does provide like some opportunities for tactical actions during down markets. So that's what we think the impact is on the opportunity set in terms of constructing portfolios. It definitely makes us work hard to justify our place in the portfolio. Like, you are paying active management fees, so we have to earn that place in your portfolios. Otherwise, for many people, you should have like a big passive component in your. I think it makes a lot of sense to have a big passive component in the portfolio, unless you have a proven manager whose alpha is worth paying for. And number two, the effect of the rise of passives and ETFs on the opportunity set. We think it's actually also good for our active managers, because to the extent that some of these correlations go up and like things go up or down together, in the short term, it does create some dislocations. It does create some additional volatility, but it's actually that volatility that allows our active managers to find good entry and exit points when things are irrationally moving together, driven by fund flows rather than company fundamentals. So in the short term, it does create more volatility. It does create more noise in the performance, but we think that in the medium term to long term, it provides better stock picking opportunities.
Got it. Okay. So increase in passive flows may be increasing the mispricing opportunities that give hedge funds their alpha. So speaking,
yes.
You said that the key is making sure that when you pay the fees that you're buying alpha and not beta. Let's move the conversation to manager selection, to alpha identification and verification. How do you know who is good, who's getting lucky, and walk us through a little bit of your thought process, your research process, and your evaluation process for managers and strategies.
Sure. Let's start with evaluating managers, right? And in our process, I usually start with asking myself if I can summarize the strategy and the manager's perceived source of edge in one sentence, right? So I come across a new hedge fund manager, and then I try to distill what their investment strategy is. Maybe it's predicting differentiated medium-term EBIT in cyclical companies. Maybe it's a GARPy or growth at a reasonable price compounder type of manager. It could be someone who's like cash flow driven or cash flow driven, focused on value type opportunities. And with that in mind, like now I have like an initial hypothesis about this is how I think the manager makes money. Then here comes like the analysis of returns, like both quantitative and qualitative, to see like, okay, what really is like the alpha here? What am I paying for? Right. So on the quantitative side of things, this is, I guess, the more science part of the analyses. You have like your usual risk and return statistics, including volatility, Sharpe, beta, correlations, drawdowns, etc. What people describe alpha as. Alpha is usually described as the manager's value add, but really it's just the residual after you decompose the sources of returns. Often people would take out market beta, or from the more sophisticated folks, various factors like momentum, value, growth, and all the other factors that you can think of. And then what's not explained in your regression is deemed alpha. That said, that supposed alpha has two components, skill and luck, right? And it's not always straightforward to discern between the two, which brings us to the next component of return analysis, which is the more qualitative look at the nature of returns. So the questions that I tend to ask myself would be, does the manager tend to make money in particular environments? What types of environments would we expect to be the most challenging? What is the return profile over an entire cycle? Often we have limited historical data, especially for new managers. So we fall back on pattern recognition. Do I have historical analogs for this? Is there someone in the past that I've met whose strategy rhymes with this newer manager? What we're really trying to underwrite here is that if the process is repeatable. And as part of that underwriting, we also have to think about, have there been any significant changes to the environment that would make one question whether a certain strategy is still effective? So one of Jonathan's questions earlier is how have hedge funds changed over time? Data point investing, for example, where hedge funds would track, say, monthly sales for like Taiwan semiconductor companies and use that to make technology investments in US companies. That was something that worked very well in the 1990s and the early 2000s, but that has become very commoditized these days. So we need to make sure that these managers we are evaluating, they're still doing something that's differentiated in terms of their analyses and their investing strategy. And then as part of that qualitative work, we also do references. We do have a proprietary database that we've built in-house, our own tech stack from the ground up. Ideally, these personnel moves at hedge funds, you're tracking not just like the top level of portfolio managers, but also like those next couple of levels. You followed them ideally at their current and previous hedge funds already. We go back to that database to see if there are people that we could get unsolicited references for. And these conversations, these reference calls, really, they go back to corroborating, disproving that working hypothesis we have about how a manager generates returns. So it's like, oh, you worked with so-and-so in the past. tell me what their work was like, how were they generating their ideas, see if that jives with your initial impressions of that research and investment process. Of course, we also try to follow people over time, make sure that they're doing what they said they'd be doing. And the flip side of that is we have to guard against style drift, especially with our existing managers in the portfolio as well. There have been a number of instances, thankfully not too many, but where maybe their original strategy isn't working, and we've seen them like drift to things way outside their wheelhouse. And usually that's a good opportunity to review that investment and see if it's quite different from what's originally been underwritten. And I'd say that's kind of like the framework that we follow at a high level. Obviously, like I'm happy to take follow-up questions, but that's on the manager selection part. And
Questions welcome from the audience at any time. I did want to ask, on the quantitative side, what are the metrics that really matter? And what are, sometimes maybe you think overstated or overhyped metrics for evaluating a manager? And then how do you balance the kind of quantitative narrative that emerges and then the qualitative narrative? Or is the qualitative part just corroboration, as you said, and you're not looking for new information from interviews or reference calls? You're just trying to confirm what you already believe?
Well, we're definitely always looking for new information. We don't pretend to know everything about a manager, and certainly there have been certain reference calls where we think someone is actually like pretty promising as a manager, but perhaps there were like certain like red flags that came up in the background where it increased the risk profile, headline risk potential for a potential manager, and we ended up passing. I will say that on the quantitative side of things, we have to be honest with ourselves on the limitations of having limited data, basically, because if someone's pitching to you their track record, usually there's going to be like a monthly track record that they show to you. If you want to start doing regressions, I would say that you need minimum of like 3 years, otherwise it's just too noisy. And even then, there's still so much noise. So the quantitative analysis actually isn't like the primary driver of our manager selection process, to be honest. It's obviously if someone has no track record of generating like attractive risk-adjusted returns, and it's hard for them to get on the radar screen to begin with. But that quantitative analysis is only a starting point, right? And oftentimes that analysis, those metrics tend to be, pick your favorite regression method, whether it's just against like higher level market beta, specific sector betas, or factor analyses, just to see like, is there some kind of like demonstrated track record of excess return generation here? But also understanding the source of those returns, right? Like if you make money in a portfolio, is it just because like of one or two names that have generated returns in a year, or is it like just a broad base of contributors to portfolio returns? Obviously, I think it's easier to underwrite someone with a broader based return generation profile, just because it means that you might have gotten lucky with 1, 2, 3 names. Could you consistently get lucky with 50 names each year that have been generating returns for you? Maybe, but it's just less likely, right? So given the limited size of data that you're crunching, we try not to draw too many conclusions there, just because we have to be respectful of like how noisy inherently that quantitative analysis is, and that's why we really have to pair it with a qualitative analysis. In some instances, it's even like we use a qualitative analysis first, and then use the quantitative work to verify that hypothesis. Again, it boils down to the availability of data and not drawing too many conclusions from an otherwise like a limited and noisy data set.
Speaking about data, I understand that you kind of lead data analytics for the firm. What are, besides the data that the firm itself gives you, are there other alternative sources of data that you incorporate into your evaluation? Are there kind of, either proprietary or more widely available tools that are kind of at the cutting edge of data crunching? Is there a role of AI in this assessment now? Where are we in the state of technology and the role of data and the sources of data that are relevant?
Thanks for that question. Let me just take a step back. So if you're a hedge fund manager and you invest in, say, stocks, bonds, even at derivatives, you can just go to Bloomberg and pull up all the security info that you want, everything standardized, and it's easy to crunch the numbers on these portfolios. In the shoes of an allocator, when you start investing in hedge funds, although there have been some efforts to standardize reporting information, it's really still all over the place. And so that's why we invested in our internal databases and apps that live on top of that to essentially tell hedge funds, hey, give us whatever data you're giving to your LPs. We'll take that in whatever form you're able to share. And then we do have internal staff who try to standardize that data just so that we could aggregate that and compare against their peer hedge funds. And then in terms of what other data we have out there, we do subscribe to market data from the usual suspects like Bloomberg, Refinitiv, and all those third-party market data providers. Sometimes we use those to track portfolio performance and to track factor exposures of our portfolios. But remember that for many of these hedge funds, you're really getting meaningful data really on a monthly basis. Some of them might give interim returns weekly or mid-month returns. Some might provide daily, but it's really not common to get very detailed daily data that you would get for stocks and bonds, for example. And so to the extent that you are using AI, it is a field with very interesting potential. It's just that the main limitation is the lack of data that they're feeding into the AI training and inference engines, for example. Now, another comment I have about AI is that could AI speed up some of our internal processes? And the answer is yes, conceivably. One of the things that we do is look for outliers in our monthly reviews of hedge funds. For example, we had a healthcare manager a long time ago where they usually ran net long, and then I noticed in our tracking systems that exposures have just gotten lower and lower to the point that they started running net neutral exposures. And I was like, wait, this is very strange. This guy's been investing as a net long manager, directional manager his whole career. And what happened? This is a development that we followed over a couple of months before talking to the portfolio manager to see what happened. And it turns out, sure enough, that He probably let non-investment considerations get in the way. He got really worried about inflation back in 2008 in the aftermath of the financial crisis because of the liquidity injections by central banks and by the government, and started putting on some crazy short positions because he was worried that inflation was going to destroy everything. So this was something that we figured out manually by tracking statistics. But if you had like AI that flagged this as like, oh, this is out of the norm, it's worth revisiting with a manager when you have a chance, I think that would be a useful function. Now, keep in mind that a lot of our systems is used for like aggregation and reporting where things have to be exact. And their AI is not quite as good as like pure relational databases yet, where like if I have a SQL database and I just pull like, oh, give me all the balances for this client, or give me all the blended returns for this strategy. It will like give me an exact number, and every time I run it, it will give me like the exact answer. With AI, you still have like the risk of hallucinations, and maybe like the math might not always be like 100% accurate, and you just have to be thoughtful about where you deploy those emerging technologies.
Thanks very much. Let's move to portfolio construction. And so we have this universe of managers and this universe of strategies. How do they fit together? How do they, complement each other, diversify against one another? How do you get the most from a basket of managers? And how do you think about building that basket?
Yeah. So when thinking about how different strategies work together or not, first, I think it's important to start with the client mandate. So I personally like to start with their risk tolerance, and I start with this as the constraint, right? It's like, okay, given how much risk you can stomach, and usually they overestimate the amount of risk that they can withstand. So just be mindful of this when setting that constraint. It's usually the approach that I take is usually a balance between those slow and steady liquidity-driven managers that we talked about in the previous slide, and then the large but chunky, quote-unquote, skill-driven managers um, where the alpha sources are chunkier, and combine those two, right? So the slow and steady type of return profile, I kind of think of that as like it forms the ballast of the portfolio. It provides like a base return year in and year out. So there's like a consistent base of returns each year. And then I add on top of that, that top layer of chunkier alpha, where they could get like this extra source of excess returns, but the timing of that can be chunkier and more episodic, right? And so the idea there is like an internal combustion engine. I know the trend is towards EVs now, but if you remember your internal combustion engines, whether it's a 4, 6, 8 cylinder engine, like at any given time you have like some cylinders firing. And so when we create the portfolio, we have a similar analogy. And our philosophy is that at any given time we want some of those like different hedge funds like firing, producing returns. And then as icing on the cake, if it turns out that like these chunkier return managers produce outsized returns for that particular period, that get that extra boost. But even if they don't, you still have that ballast of slow and steady return generation. So that's, I would say, the first level of grouping of managers. And then I alluded to being cognizant about like a manager's like net exposure and overall exposure to markets. So when you put everything together, We look at the resulting risk profile of that. It's like, is that still within the client mandate? Do we need to like tone down market exposures or certain factor exposures, or do we have like more room to run? Maybe we can like add more maybe managers that have higher return expectations but are a bit more volatile because we have more room in the vol budget to run. So that said, we also have a limited number of line items in the portfolio usually, just because you're not going to like give like a client something with like 50 to like 100 line items in the portfolio. That's just too many. So oftentimes that means we have to justify each manager's place in the portfolio, make sure that each addition brings something new to the table.
Typically, how many managers in a portfolio? I'm sure it depends, but give us a range.
I would say that for our equity long short mandates tends to be like I would say 15 managers plus minus would be like a good place. Like some clients might be closer to 20, someone more concentrated portfolios, maybe closer to like low 12, 13 portfolios. And then if you want a more diversified portfolio, including those like slow and steady profile type of hedge funds, say, then we get to like 20 to like maybe 30 managers max. So with that in mind, maybe you don't need that fifth growth technology manager in your portfolio. Otherwise, like it's hard to justify why this one is very different from like all your other technology managers out there, right? And so that could be like the first pass in portfolio construction. We'll do like pro forma analyses of new manager additions, like how does it change the portfolio? Does it change the risk or return profile materially? And then going to the quantitative exercise, then we do like some, I guess we call them risk return optimization, but this is usually done as a check by us, not as a driver. And the reason why it's not necessarily a driver is because when you're doing these risk return optimizing exercises, you're relying on a bunch of assumptions. And by definition, when you're optimizing, you end up with an edge case. And when you end up on an edge case, when you're blindly optimizing, that means you're relying on one or a couple of particular assumptions to be like very, very true. And the cost of a mistaken assumption there is potentially very high. So rather than be very cute and like try to optimize for that like last bit of like risk and return trade-off, oftentimes it's like a more iterative exercise on our part. So, okay, let's have this starting portfolio. Let's run the optimizer. Oh, it looks like we're kind of far from that efficient frontier. Are there ways to like tweak the portfolio? And then we look at it first, like, does it make sense? Are we over allocated or under allocated to certain strategies or factors? And then like repeat that like several times. And then we usually end up in a place where we run the optimizer. It's close enough to the efficient frontier, but at the same time, it checks all the qualitative like boxes that we are looking for as well.
Filbert, can you talk about rotating managers? Turnover. How often you reevaluate and re-underwrite. When it's time to pull the plug. What are the when do you give people a second chance, and when do you say like we need to cut this from a portfolio?
Yeah. So I take what I say with a grain of salt, just because it's like one allocator's perspective. But the approach that we follow when building hedge fund portfolios is we tend to be quite long term about this. So throughout our history, our average manager turnover by count in a portfolio is about 10% a year. The idea is that when we underwrite managers, we want to be able to underwrite to be in these managers for like at least like the medium term, ideally for a longer terms. And so we want to be able to underwrite their behavior under a whole range of scenarios, like up markets, down markets, environments that are conducive to their performance, environments where they might struggle, and then we'll have like a range of expectations for each of those like different environments. And so for us, if we go into like a new manager, we underwrite them for the long term, and then 2 years later we're out, we have to ask ourselves like, did we underwrite incorrectly? Like, why did we not foresee this thing that caused us to redeem? Otherwise, is it something that maybe we could have underwritten better, or was it because like the manager just changed completely? And sometimes it's the latter. Like, for example, that healthcare manager that we invested in, and suddenly he decided he became like a macro guy. It's like, okay, that is not what we underwrote, and it's all bets are off because he's changed his strategies, right? And then I would say what we have to be more aware of, and this is where it pays to really pay close attention to managers, and also look for like outliers, is instances where perhaps the manager hasn't changed, but the environment has changed, and that's why their strategy isn't working as well anymore. So in the past, we had a manager that's focused on financials, especially banks. They were making money like figuring out like which banks are doing better than others, and picking winners and relative winners and losers, and making like very good money each year, like that spread between long and short positions. And then the financial crisis hit, and then he had like a bank bailouts, and then all of a sudden, all the banks started trading together, where it doesn't matter whether you're like a big money center bank or like a small regional bank. The correlation just went up, and everything started trading together, and then it was just harder to do like stock picking there. And so as part of our monthly review process, like deconstructing where different hedge funds made their returns, and seeing like what the contribution was. Like, was it like concentrated or broad based? Was it like beta? Was it more like alpha, or like excess returns, or were they just in line with the markets? And then having that regular evaluation of managers, while not taking any single month too seriously. But if you get several repeated observations of things being like outliers, or things being different from what you had initially underwrote, then it calls into question like, okay, like, has something changed here? Should we be re-underwriting this manager? Should we be taking them out of the portfolio? So even though we underwrite managers to like 5+ years in the portfolio, we're not hesitant to cut bait, if you will, and exit managers we think that they've departed sufficiently from what we've underwritten, or if the environment has changed sufficiently such that it impairs the manager's ability to generate excess returns.
Once again, audience, your questions are welcome, either in the chat or use the raise your hand function, and we'll call on you. In the meantime, I still have a million questions, so I'll keep at it until someone else jumps in. We have a lot of emerging managers in our WOA community. How do you think, from an allocator's perspective, you're talking about running 3-year sessions and underwriting for 5 years? How do you view emerging managers, and what advice would you have to emerging managers that are trying to build trust and get started? Everybody has the dilemma of nobody wants to invest until they see who else is invested and you have a track record, but how do you get started? Speak a little bit to the emerging manager experience from your perspective.
So I think that goes to I can use that as a segue to talk about like some of the things that we do in terms of sourcing and um, tie that back to like emerging managers. So I mentioned earlier that we tend to track personnel moves at hedge fund managers, and this would be like not like this includes that middle layer of um, professionals where maybe they're like a sector head or they're like a junior portfolio manager, see who the up and coming people are. And even though we might not have like their exact track record, because a lot of hedge funds like won't give them to us, but because we have these frequent conversations um, with hedge funds about like where they're making money, where they're losing money, who's the analyst or portfolio manager responsible for these things. You can start seeing patterns about, oh, this guy has consistently like not only has he had like some consistently good picks, but he's able to convince the portfolio manager to size up his positions when he has like the highest conviction or when he thinks that they should be like sized up because of the particular opportunity set. So um, if they're still at their existing firms, it doesn't help. It doesn't hurt to speak with investors earlier on, just to like get on their radar screen so they know like who to follow. But for those that, especially with the growth of platforms these days, where you have a lot of pods and you have a lot of managers here. Some of them let you keep your track record, and others that might not. I think you kind of have to like triangulate here, where it's like, okay, I know that this um, pod shop has like pretty tight risk limits. So for someone to um, be there for like this amount of time and running this amount of capital, therefore I have to like I can conclude that they're perhaps like producing pretty good like risk adjusted alpha there, and they probably have like some decent risk management, so it's worth a second look. And I would say that it's if they have a deal with pod shop to like make the returns shareable, that's great. Otherwise you end up relying more on these like reference checks and kind of like I guess the astronomical equivalent of like deducing the existence of a black hole by looking at the behavior of things around it. It's like, okay, like the fact that they survived this long or like were promoted to like do this and that like over a span of how many years probably indicates something, and at least now that can give me a hypothesis that I can test. So um, the I guess to answer your question is like, yeah, get in front of like investors um, radar screens, and also uh, try to see if you can you're able to share color around your time at the shops without violating NDAs of the firm.
Okay. We have a question from Ben. What is the discussions looking like post-election in terms of whether allocators are looking to pivot their portfolios in ways? So this is bringing us back out a little bit to the current day in the macro. What are you seeing in the market right now post-election?
I would say that our fund managers have, in general, fared well since the election, but the whole market has gone up a lot, right? Maybe what's more important is how they position the portfolio before the election, because um, I thought that was crucial in setting up the portfolio to do well and also to avoid some of the potential losses post-election. So going into the election in the U.S., I think a lot of managers realized that there's like some increase in volatility that's likely regardless of who wins the election, and therefore they decided for risk management purposes to take out outsized exposure to names or industries that might like unduly benefit or suffer, at least on a sentiment basis, when either party wins the election. So they did pre-position the portfolio so that they're not too exposed to like factors that might be more volatile under one administration versus the other. And then on the short side as well, they're aware that certain industries and certain meme stocks might be more actively trafficked under one winner versus the other. So they prudently exited many of these like potentially volatile shorts that true enough spiked right after the election, even though there were no like fundamental changes in the business models of these companies. So without those risk management changes before the election, I think might have been a couple of places in the portfolio where short squeezes could have hurt, but thankfully we were able to largely steer clear of that. I think that the takeaway here is that yes, it's important to do scenario analysis to make sure that your portfolio won't be like unduly volatile in one outcome or another, because that just makes the risk too binary. But rather, maybe the better scenario is to like keep some dry powder so that once the election results become clear, then you can use that dry powder to like figure out, okay, like longer term, are there fundamental changes in terms of the regulatory landscape or the administration's priorities where certain businesses will benefit over the medium term at least, and reallocate my dry powder
there. Another question Ben had earlier in our chat before this was about let's call them emerging strategies. You talked about the pod shops. How has the role of multi-strat, of pod investing, also of quant shops, and of crypto funds, liquid token crypto funds. Each of those are very different, but maybe you could just give us one by one, kind of like, how differently do you think about each of these? Different frameworks apply, or is it the same thing? And what are the interests, demand signals you're getting from your clients, and what are you talking about with them?
So I think multi-strat funds, this would be this has several I guess aspects that rhyme with the types of mandates that we have for institutional clients. So the goal here typically is to like create like an all-weather portfolio, or at least a portfolio that can like provide a good balance of like downside protection, but still consistent alpha generation in like various types of environments. And now the question is like, do you want to do that? Basically, give your money to like one hedge fund, trust that I have expertise across different strategies, and have them do the allocation, or do you have someone like us build a portfolio of specialists for you? So that, I think, is definitely like a question. That's a question that's definitely worth asking. There are trade-offs because if you pick one manager, multi-strategy manager, to do everything, there's more capital efficiency there. But the question is like, okay, like, are they like as equally well versed in equities versus like in credit, and some of these arbitrage strategies versus like a collection of like super specialists in each strategy, right? But I think it's and then these pod shops and platforms are kind of like in between, I would say, sector special, like these single strategy funds and like multi-strategy funds, because some of them might be like, okay, we'll specialize in equities, but we'll have like all these different types of equity managers. So they're somewhere in between. I think my view there is that they could play an important role in your portfolio. Just make sure you're aware of the trade-offs in terms of like capital efficiency versus um, individual manager skill, and also the liquidity that's provided by these multi-strat shops. Right, a lot of these pod shops that have been in the headlines recently. Because there's a lot more demand for them. They're able to like make the liquidity really, really tight. And so we're talking about like taking 5 years to like get your money out, right? So is that a trade-off that you're willing to make? Are you being compensated for that illiquidity risk? Because as we mentioned earlier, one of the benefits of like hedge funds, at least the portfolios that we create, is we try to keep them reasonably liquid. You can take a large portion of your money out every quarter, and certainly a vast majority within like a year. So in case you do get like these dislocations and you want to act tactically, you are able to tap that liquidity. In terms of like the quant shops, I think they're also like a place that we have been doing more research on lately. It's definitely been like a much welcome addition in terms of potential um, yes, options in our portfolios. So previously, we've perhaps had a preponderance of more fundamental oriented managers where the return profile tends to be chunkier, and they look at like company specific investment opportunities. With a lot of these quant shops, they tend to be more systematic. Well, some of them they span the gamut, right? Some of them are trend followers. Some of them are like more mean reversion. Some of them are just doing like a kind of like risk parity stuff. So whether we like individual strategies or not, we do have to consider them, especially like when clients ask about them, like is there a role for them potentially in the portfolio? Because in many cases, some of these quant funds can have a different risk return profile and also have lower correlation with the rest of the portfolio. So it's certainly worth examining as a potential addition. That said, we also have to be aware of the risks inherent with some of these strategies, especially the ones with a lot of leverage, because when liquidity seizes up, like some of these quant funds, or when trends reverse, some of these quant funds can be down significantly. And so we have to be aware of like those risk return trade-offs there. And then as for crypto, I will be the first to admit that I'm not an expert here. It's hard to assign an inherent value to coins where the main determinant is like how much other people are willing to pay for it. But if you're like a high net worth individual, you're a family, you want to like allocate a portion of your portfolio into more speculative assets, like you can certainly do that. It's just that when you're managing an institutional portfolio where your client could be tapping like these investments for like funding needs, you probably don't want that to be like an outsized portion of your portfolio. But certainly, if you want to just have like a small like flyer there, or at least a portion of your portfolio where you don't need liquidity for the foreseeable future and are willing to take that risk, then by all means. It's just that I will not claim to have expertise in that front, and so have largely stayed out of it, at least in our client mandates.
Got it. And we're in our last 5 minutes here, so this is the time to get in your questions, everybody. U.S. equities have outperformed for a long time. Valuations are high from a historical perspective. What appetite are you seeing in terms of adding to or redeploying to China or emerging market equities, or adding these managers. And I guess, China is kind of a special case, but so maybe you could talk about emerging, EMs and then China specifically.
I think the beauty of being involved in the hedge fund space, where a lot of our managers are long and short individual securities, and we're more focused on stock specific dispersion rather than entire the market, the moves of the market as a whole. Um, we think there are like interesting opportunities in China and more broadly EM, because we're not gunning after, we're not trying to predict like where the market as a whole is going to move, right? That said, an important consideration when looking at the opportunity set for equity long short investing, for example, is to figure out like, is the investment environment, is the business environment predictable enough so that we could figure out what happens to the business, what happens to shareholder returns in different parts of the world, in different states of the world, um, and based on that, like build our models to see like, okay, what like the base case versus um, like some downside cases here, what's a probability of each case, and with that, use that to like build a portfolio of long and short positions. And so for us, as long as that environment is predictable enough, the manager thinks that he or she can like figure out like which companies in China will do well under like the current regime, at least for the near to medium term, and then which ones tend to have shakier prospects. They're still able to generate portfolios that have like good long short spreads, and to the extent that other people like the beta chasers are shying away from the Chinese market, it's actually um, it makes it like a more attractive like hunting ground, for example, where valuations might not be as stretched for the long positions and potential long positions, and then um, it might be like names that under normal circumstances they might be too expensive. Valuations might not be attractive enough, because people are shying away from this space. It's there's some like bargain opportunities. At the same time, maybe they don't want to be too exposed to Chinese beta, and so they have to like also figure out, are there enough things to put on the short side just so that they control overall China exposures. But to answer your question, as someone who pays managers to capitalize on stock dispersion rather than beta, we like China, we like EM.
That's great. Terrific. We're gonna start coming to an end here. We're just at our 75 minutes. I want to thank Philbert tremendously for this. I've just launched a poll in the group. You've had 35 attendees rapt attention for an hour now. I think there were at some point 45 people attending. So everyone that's on the line, please take a moment to fill out the poll. This is kind of a new for us. We just want to make sure that we're asking the right kinds of questions and talking about the right kind of topics. So please do take a moment, fill out the poll, give us feedback. Will mean a lot to us. And Philbert, I just want to finish by thanking you. If there is any like final word of wisdom that, whether it's inspiration, encouragement, you have a plug for something, or just a mindset that you want to leave people with, want to give you the last word. And again, on behalf of the whole WA community, thank you for spending this time with us.
Yeah, I think that if there's one takeaway from this, at least from like an allocator's perspective, is just to like really be honest with yourself, and to the extent you have clients, your clients, about to the extent you're putting hedge funds in a portfolio, like what do you want that role to be? Like which bucket of like those like different functions, asset class functions that I showed earlier. You want it to be like, if you really think it's meant as a diversifier or risk mitigant, then don't pitch it to them as a growth driver, for example. But on the other hand, if a client wants to create like a hedge fund portfolio that is essentially a substitute for equities, then just be upfront about like what the expected risk of that portfolio might be. And so just being upfront, a lot of these like expectations will save a lot of like a heartache later on when they get mismatches. We're like, oh, S&P is up 30% today. Why is your hedge fund portfolio up only 15 to 20%? It's like, what? Do we have a beta of 0.2? But setting those, that said, even if you set those expectations up front, like it doesn't stop clients from like ranting about about that anyway. The only other thing I'll mention is that this was meant to be like, I guess, just like high level of educational discussion, and I have purposely kept things pretty high level because I don't know where like each person's comfort level was at. But to the extent you have any follow-up questions, my email address is on the screen. Please feel free to reach out. I'd be happy to go as deep as you want, and just try to make this like an intro discussion, at least cover some of the high level topics. So again, thank you everyone for your time and for being so generous with your lunch hour.
Thank you, Filbert. Thank you to all the participants. WOA members, note there are end of year gatherings taking place in Beijing, Shanghai, and Singapore over the next couple of weeks. I think the Hong Kong chapter just met last night. So please do follow up in the community, come to the end of year events. If you're not a member of WOA, like to be and learn more about coming to one of our events, please do reach out either to me or to one of our members. The intro deck is in the chat. And thank you all for spending this time with us. And thank you once again, Filbert, for joining us. We'll see you all at the next WOA event. And until then, keep your heads up in the markets, and we'll see you soon. Take care all. Thank you.